This video, we'll be going over IRS Form W-4, Employees Withholding Certificate. If you haven't completed a Form W-4 in quite a few years, you might notice that this is a little bit different from the withholdings form of old. So a couple years ago, the IRS changed Form W-4, and it used to have a lot of allowances that you would just enter these numbers, and then employers would just go to some magical booklet somewhere. Actually, it's called IRS Publication 15T, and that's the tax guide for employers. But once you filled out your W-4, you put in a bunch of numbers. They didn't quite make sense, and then it just went off, and you probably never worried about it again. With this tax form, you actually have a little bit more in the way of options, and we'll go over each of those options. But then you can also incorporate things that you personally know about your tax situation. So if you know that you're entitled to certain credits, you can update your W-4 to reflect that. If you know that you're taking certain allowances on Schedule 1 or deductions from income, making adjustments to income on Schedule 1, then you can make allowances for that. So we're going to go through this form. You can see that we've already kind of completed part of it. So there are 5 steps to this form. Most of it's on one page, but there are a couple of worksheets. They may be optional that will come into play, and we'll use those worksheets to kind of help us fill in some of these gaps. So let's go ahead and start at the top of the form with step 1, entering your personal information. As a quick backstory, this is John Doe. He's a married taxpayer filing a joint return with his wife, Mary. We're completing his W-4 form, but we'll also walk through what Mary would want to enter when we get to that, because they do have 2 jobs, and so we'll walk through how they would report their situation. So at the top, we'll put in John's first and last name, his full social security number, address, and then his tax filing status. So you'll want to make sure that this is correct. This does impact your withholding tables. And then in step 2, the form instructions specifically say steps 2 through 4 if they apply to you. So if you need more information on each step, you can go to the instructions. They're on the same page. And then the worksheets that we'll be referring to are on page 3. And then there are some filing tables that we'll get into that are on page 4. Okay, so everything you need generally is either on your income tax return from your prior year, or it's in the form instructions. So for step 2, there are 3 ways that you can use this. So you only need to complete step 2 if you have two working spouses, or if one person is holding more than one job. So if you're just single taxpayer, one job, then you don't necessarily need to complete step 2. You can still use the IRS withholding estimator regardless of your tax filing status. But if you have self-employment income, you may choose to use this as well. There is a video that we put together. We'll put a link in the show notes on how to use the estimator. You would then use that result to enter the amount in step 4C. So this would be the amount right here that you would enter once you get through the estimator. So in step 2B, we're going to go to the multiple jobs worksheet, and then we're going to enter that information in step 4C below. So let's go to the multiple jobs worksheet. So we completed this based on some instruction. So I'll kind of outline that. So in the case that you have two jobs, or if you're married and filing jointly and you and your spouse each have a job, then you're going to use the appropriate table. There's a table for married taxpayers filing a joint return, as well as qualifying widowers or widows. There's a table for single taxpayers or married filing separately. And then finally, there's a table for heads of household. So make sure you find the right table. And what you're going to do is you're going to identify the higher paying job row and then the lower paying job column. So John makes $100,000 per year. Mary makes $50,000 per year. So we're going to go to this top table for married filing jointly. We're going to go to the row for higher paying job. We're going to the 100,000 to 149.9. And then we're going to meet the column where Mary's job is, the lower paying annual taxable wage and salary. So 50 to 59.9. So this intersection leads us to 98.20. As you can see, this is what we put up here. Okay. So then, because we're not using the 3 jobs step, we can skip to step 3. Now we're going to enter the number of pay periods per year for the highest paying job. So in this case, John is paid semi-monthly, which means he gets paid twice a month. So we put down 24 pay periods. And then you divide the amount on line 1 by the line 2C amount. So you do this and we arrive at $409. Now this 378, this is what happens if you divide that by the number of biweekly pay periods in a tax year. So 98.20 divided by 26 would result in 378. And the reason I point this out is because this is a very common mistake that a lot of taxpayers make, where you are paid semi-monthly, but you might enter bi-weekly by mistake, or vice versa. So be very clear, and if you need to, check with your HR department on how often you get paid. So it's either bi-weekly, which is every 2 weeks, in which case there are 26 pay periods per year, or it is semi-monthly, in which case you have 24 pay periods per year. So we're going to use this one, which is the correct situation for John. So this 409, we put that up here. Okay. So now let's go back and let's just kind of walk through what would happen if you had 3 jobs. So what would happen is you would use the top 2 jobs, the annual wages from the highest paying job, and the annual wages from the next highest paying job. So let's just say that we have 3 jobs. The first 2 are 100,000 and 50,000. So we're going to cheat a little and just use the same information here. So now we're going to add the wages of the 2 highest jobs from line 2A. And then we're going to use that in the higher paying job row. And then we're going to use the annual wages for the 3rd job. So let's say that we have a 3rd job with $30,000 a year. The highest 2 paying jobs total $150,000. So we move to the next row and we're going to go to the $30,000 a year column. And that gives us wrong column. $8,230. So we would then add the 8230, and then we would add these amounts together and we arrive at 18,050. In this case, we would then divide that amount by 24. We would take this the result that ends up in line 4, and that would be the number that we put into uh, the line 4C up here. Okay, so that's how we would walk through the tax situation if there were 3 jobs. So if you only have 2 jobs, then you can check this box. You would need to check the same box on Form W-4. And this basically splits in half your standard deduction and kind of just treats each job as if they're equal, roughly equal. So you can do this if the pay at the lower paying job is more than half of the higher paying job. So in John and Mary's example, we probably wouldn't want to use this because John is making 100,000 and Mary's making 50. But if John was making 100,000 and Mary was making 90, then this would probably be close enough. So the IRS does say that the tax estimator up here is the most accurate. So you can use that. The multiple jobs worksheet is more accurate if there's a huge disparity in the 2 jobs or if you have 3 jobs. But if you have 2 jobs that are roughly similar, then step 2C might be your better option. So now we're going to complete steps 3 through 4. We should do this for the highest paying job. In this case, that would be John's. Mary would not have to complete steps 3 through 4B. She would only put in the amount of withholding. So let's just go back and double check that one thing. So you would only complete the worksheet on one Form W-4. So in this case, this would be John's Form W-4. Now, if you haven't updated your withholding since 2019, the IRS says you should submit a new Form W-4 for all jobs that you have. And then if you have more than 3 jobs, or if there's one job with annual wages of more than 120,000, then you may need to refer to additional tables in publication 505, or you might need to go to the tax withholding estimator on the IRS website. So step 3 is for people that know that they're going to claim tax credits. Probably the most common one would be the child tax credit, followed by the credit for other dependents. And that's kind of what's clearly right up here. So if you know you're eligible for the child tax credit, you can go ahead and incorporate that into this. So John and Mary have 1 child. She's under the age of 17. So we simply enter $2,000. They don't have any other dependents. They also have income that's less than $400,000 as a joint tax return. So we've entered the $2,000 here. So to qualify for the child tax credit, the child has to be under the age of 17. The child has to have a social security number, and the child has to have lived with you, and you had to have provided more than 50% of that support for over half of the tax year. So this is kind of one of those, if there's, a divorced couple or a couple that never got married and they're each trying to claim a tax credit, the IRS rules clearly state only one or the other, not both. So in this case, John and Mary's situation is pretty straightforward. However, you can also use this for any other tax credits that you may definitely know of. So if you go back to your prior year tax return and you see that you filed a credit for the foreign tax credit, or if you know that you had a bunch of home renovation projects and you might be eligible for residential energy credits on IRS Form 5695. If you bought a new electric vehicle and you might be able to claim a credit, you can go ahead and incorporate that on here. Now, if there are one-time tax credits that you incorporate in here, then you may need to go back the following year to back out that credit. So if you know that your child tax credit is about to expire because your children are aging out, you need to make this adjustment, or else you're going to get hit all of a sudden with a big tax bill and kind of wonder why. So keep on top of this. In step 4, these are all optional. So in step 4A, if you have other income, not necessarily from jobs, but if you like, for example, have IRA distributions, or if you receive a significant amount of interest or dividend income on your Form 1099s, then you may decide to have withholdings taken here. Just double check to make sure that you're not having your other income withheld. So for example, a lot of financial institutions will allow withholding for IRA distributions. So let's imagine that John and Mary are withdrawing $15,000 from their IRA, and they're age 60, so there's no early distribution penalty or anything. If John withholds this at 10% from his financial institution, which they can allow him to, and then he withholds here $1,500, well, now he's withholding 20%. That may be the right answer. That may not be the right answer, but at least be aware of the different places that your taxes are being withheld from. Deductions. If you want to claim deductions other than the standard deduction, then there's a worksheet for that. So let's go to the deductions worksheet. So again, in this situation, we think that we might be claiming itemized deductions on Schedule A. So we go ahead and put those in. We enter the standard deduction amounts here. It turns out that our itemized deductions are less than the standard deduction, so we enter a 0. However, you can also enter any adjustments to income on Schedule 1. So this might include student loan interest, deductible IRA contributions, contributions to a health savings account, moving expenses for members of the armed forces, for self-employed people, the 1/2 of the self-employment tax, things of that nature. So these used to be called above the line deductions. They're adjustments to income instead of adjustments from income. So take a quick look at your Schedule 1 from last year to see if any of those deductions will apply this year. You can enter that here, and then you would just add those two up. So in this case, we only have the $5,000 of the above the line deductions from Schedule 1. If we had, say, $45,000 here, then we would subtract the difference. We would get $15,800, and then we would add this here. So in this case, we're just going to stick with the 5,000, and we have that plugged in at the top here. So this line 4C was the withholding that we calculated up in step 2. And then that's it. You sign it and you date it, and then the employer processes it. So how it works is that there is an entire publication dedicated to telling employers exactly how to withhold taxes from your pay based on the instructions that you give them in Form W-4. So if you don't file a Form W-4, if you have one that's up to date, then one of two things is going to happen. Either you're going to get a much larger tax refund than you wanted to, and that's not good because you're basically giving Uncle Sam an interest-free loan. And if you're worried about, cash flow, like you're having trouble making ends meet every month, adjusting your W-4 is a good way to fix that, because you may be withholding too much in taxes. And instead of just waiting for tax season to come around so you can get a big refund, you could adjust your W-4 so that you get a bigger paycheck. The other thing that might happen if you don't properly update your Form W-4 is that you might withhold too little, and then you end up owing taxes, and tax season being right after Christmas season when a lot of people are paying off credit card bills. That's not a good combination either. So keep on top of your Form W-4. Lots of people work with financial planners who this can be a part of a financial planning meeting where you sit down, usually during the summertime, after tax season is over, and just go over your tax return, your prior year tax return, and then see if you need to make adjustments to your tax withholdings. So you can do this with your financial planner. You can do this with your accountant. Usually, most people would wait until after tax season to do this tax planning with their accountant. But each accountant and each financial planner should be more than happy to have this conversation with you so that you're having the correct amount of taxes withheld. So we mentioned a lot. So that's all we have for this tax form. We did mention a lot of tax forms and schedules in this video and in our article. So we'll put links to everything in the show notes. We'll put links to the article here where we go into a little bit more detail. We also provide copies of all of these worksheets and the tables in the article. So we'll put a link in the show notes for everything that we mentioned here. If you like our articles, please subscribe to our newsletter. And if you like our videos, please subscribe to our YouTube channel. And if you have any questions, comments, or if there's a topic you'd like to discuss in an upcoming video, please hit me up in the comment section. Thank you very much and have a great day.